Picture this: the world's biggest debt cliff is coming. By 2026, trillions of dollars of debt, government, corporate, and household, are set to mature and roll. Liquidity, what has fueled markets for the past decade, may begin to crack. In that moment, most paper assets will be exposed. But there are a handful of assets, real, tangible, and scarce, that stand as bulwarks. Today, I'm going to show you exactly which ones, and why, in my view, they could be the only truly safe assets as we sail into 2026. Every time I look at the markets, the noise is overwhelming: headlines, volatility, fear, euphoria, and predictions that swing wildly from one extreme to another. Yet over decades of studying innovation, disruption cycles, and economic history, one truth has remained consistently clear: the greatest investment outcomes rarely come from perfectly timing the market. They come from consistently showing up, and that is why the most powerful strategy most people overlook is surprisingly simple: buy a little every payday. This idea isn't about buying blindly, nor is it about ignoring risk. It's about understanding that innovation, long-term value creation, and compounding don't reward sporadic action, they reward discipline. When you put a small amount to work every time you get paid, you're effectively removing emotion from the equation. You're allowing data and long-term trends to work for you, rather than letting sentiment pull you into reactive decisions. Every disruptive technology, from artificial intelligence to genomics, robotics, energy storage, and blockchain, moves through cycles of hype, skepticism, and exponential growth. Most investors only show up during the hype phase. But real wealth is captured in the quiet accumulation phase, when the outlook feels uncertain, when the crowd is distracted, and when fear has temporarily depressed prices. That's precisely when buying a little consistently can position you for outsized outcomes when the long-term trend asserts itself. What many people misunderstand is that the market doesn't reward perfection, it rewards persistence. If you wait for the right moment, you'll miss dozens of opportunities disguised as volatility. But if you simply commit to buying small, steady amounts with every paycheck, whether prices are rising, falling, or flat, you transform volatility from an enemy into an asset. You capture lower prices during downturns, and you continue building exposure during upswings. It's a strategy that mathematically increases the likelihood of long-term success, because it fundamentally aligns with how disruptive growth compounds. Think about technological innovation. It rarely moves in a straight line. Breakthroughs come in bursts. Market sentiment reacts instantly, often mispricing assets both upward and downward. Yet the underlying value creation, the actual innovation, moves relentlessly forward. When you buy consistently, you're aligning your capital with that underlying trajectory, not the emotional swings around it. There's also a psychological power in this approach. Most people underestimate how freeing it is to automate good decisions. When your investment habit becomes as routine as paying a bill or buying groceries, you stop second guessing yourself. You no longer chase tops or panic at bottoms. Instead, you become an investor whose strategy is rooted in logic, not impulse. Over time, that calm, disciplined posture becomes a competitive advantage. And let's be clear, this strategy isn't about buying everything. It's about identifying a small number of high-conviction areas, the sectors where disruptive innovation is rewriting the rules of productivity, cost curves, and global competitiveness. These are the sectors where long-term exponential growth can overwhelm short-term volatility. When you combine high-conviction innovation with a steady accumulation strategy, you create a powerful engine for wealth generation, even in uncertain macro environments. Every major transformation in history looked chaotic up close. Electrification, the internet, mobile computing, each wave had massive skeptics, violent price swings, and countless calls of "it's over." But those who kept accumulating through the noise were the ones positioned to benefit when exponential adoption finally hit its inflection point. So when people ask what's the safest long-term strategy, I always return to this idea: don't try to outsmart every cycle, instead commit to buying a little every payday. Small amounts consistently deployed into the highest potential innovations can become extraordinary outcomes when given enough time. Volatility will come, sentiment will shift, but innovation will continue compounding, and your disciplined consistency ensures you're part of that story. In a world obsessed with timing, the real advantage is time in the market, especially in the places where the future is being built. When people hear a number as bold as $1, 5 million Bitcoin valuation by 2030, their first instinct is disbelief. And that reaction is understandable because every major technological or financial transformation in history has looked impossible right before it became inevitable. What may seem outrageous today begins to look conservative once exponential adoption, declining cost curves, and institutional integration start to accelerate all at once. Bitcoin is now entering exactly that phase of convergence, where multiple forces, technological, economic, and behavioral, are aligning to create the kind of asymmetric upside that traditional models fail to capture. The most important shift happening today is institutionalization. For more than a decade, Bitcoin thrived primarily as a retail-led phenomenon. Now, however, we are witnessing a structural transition. Major asset managers, sovereign funds, and corporations are moving in. Not because it's trendy, but because it's becoming mathematically irresponsible not to own a scarce asset with built-in supply constraints in a world of expanding money supply and increasing fiscal pressure. Institutions used to worry that Bitcoin was too volatile. Now they worry that they own too little. That mindset shift alone can re-rate the entire asset class. Another transformative force is the supply dynamic. Bitcoin's capped supply of 21 million coins with predictable halvings that continually reduce issuance means the marginal supply hitting the market shrinks even as demand broadens. When you combine declining issuance with long-term holders removing supply from circulation, the float becomes shockingly thin. Historically, every time Bitcoin approached this kind of supply squeeze, it triggered price movements that traditional analysts failed to model correctly. Now imagine that same supply shock occurring while trillions of dollars in institutional capital seek scarce, non-correlated assets. The math begins to look less like speculation and more like inevitability. Then consider the macro environment. Global debt is rising at a pace that even legacy institutions are calling unsustainable. Monetary systems are being stress-tested in a way we've never seen in the modern era. In such a landscape, the demand for alternative stores of value, assets not controlled by any government, not vulnerable to dilution, and not tied to any one country's fiscal discipline, increases dramatically. Bitcoin isn't just an investment in this context, it becomes insurance. It becomes a hedge against monetary dysfunction and a call option on a more transparent, decentralized future financial system. And when an asset begins functioning as insurance on a global scale, its valuation model transforms completely. At the same time, technological and financial infrastructure is maturing faster than most people realize. Custody solutions are now institutional grade. Regulatory frameworks in many major markets are clarifying. Payment rails are becoming faster, cheaper, and more integrated. Layer 2 networks are scaling Bitcoin's utility beyond a simple store of value. And AI-driven modeling is improving our ability to analyze adoption patterns with precision. The result is a more interconnected, more robust ecosystem that supports long-term growth far more effectively than in previous cycles. What people underestimate most is the power of exponential adoption. Human intuition understands linear growth slow, steady, predictable, but Bitcoin is following an exponential curve, similar to how the internet, mobile phones, and cloud computing expanded. Early skepticism always gives way to mass participation once the adoption threshold is crossed. By the time the world recognizes the inevitability, the price has already moved, and we are approaching that threshold rapidly. $1, 5 million target by 2030 isn't a fantasy when you understand these layered dynamics. It reflects a world where Bitcoin captures a share of global wealth, institutional portfolios, cash reserves, and emerging market savings, all categories where even a small percentage allocation creates monumental price impact. What seems bold today may soon seem obvious, because that's how disruption works. Slowly at first, then suddenly, and then all at once. When I look across the entire landscape of artificial intelligence, from training models to inference, from semiconductor architecture today to efficiency, from enterprise adoption to consumer integration, one truth becomes clear. The next decade of market leadership will not be determined by who moves the fastest today, but by who is positioned to scale intelligence most efficiently tomorrow. And that is why my highest conviction AI pick for the next decade is the company building the foundational infrastructure that every other AI breakthrough will depend on. In every technological revolution, there is a critical layer that quietly becomes the backbone of the entire ecosystem. During the Internet era, it was networking and cloud architecture. In mobile computing, it was semiconductor efficiency. Today, in AI, the real competitive frontier lies in accelerating model performance while simultaneously reducing cost curves. That combination, speed plus drastic cost decline, is what enables exponential adoption. And right now, only a handful of companies are positioned to drive that transformation at scale. But among them, one stands out not because of hype, but because of a structural advantage that compounds with every generation of technology. This company's core innovation is its ability to collapse the cost of computation far faster than anyone anticipated. AI is ultimately constrained not by ideas, but by compute. Training large models, deploying inference globally, enabling real-time decision, making all of it rests on the economics of processing power. If the cost curve does not bend dramatically downward, AI adoption hits a ceiling. If it does bend, if computation becomes cheaper, faster, and more accessible, then AI does not simply grow. It becomes ubiquitous, and this company sits at the center of that inflection point. But what makes their position even more compelling is that they are not merely a hardware business. Hardware alone cannot define the next decade of AI integration does. The synergy between software optimization, customized chips, on-device intelligence, and a platform designed to accelerate a full stack of AI applications gives them a moat that widens as the ecosystem grows. In other words, every breakthrough in language models, robotics, autonomous systems, biotech simulation, and generative AI increases demand for exactly what this company builds. They are tied not to a single AI application, but to the entire AI economy. Another key factor is the nature of AI demand itself. Traditional enterprise cycles move slowly. AI's different adoption is accelerating at a pace even the most optimistic analysts underestimated. Companies that once spent years planning digital transformations are now racing to integrate AI into every workflow, every product line, and every customer interaction. That urgency creates a structural tailwind for the platforms that enable enterprises to deploy AI at scale. And this company's technology has already become a default choice for innovators pushing the frontier in automation, medical research, supply chain optimization, financial modeling, energy discovery, and generative intelligence. What's equally important is the deflationary power embedded in their roadmap. True technological revolutions drive down costs so aggressively that demand increases exponentially. AI is following the same pattern. As the cost of intelligence falls, entirely new markets emerge, markets that were impossible under previous cost structures. The company leading that charge doesn't just ride exponential growth, it creates exponential growth. It sets the pace, it defines the frontier, and while headlines often fixate on short-term volatility, the long-term trajectory rests on fundamentals: compute dominance, architectural leadership, ecosystem lock, in, and the compounding nature of innovation cycles. When you put all of these pieces together, the hardware moat, the software integration, the cost, decline curve, the enterprise adoption surge, and the multi-sector use cases, the path becomes clear. There will be many winners in AI, but the company driving the intelligence infrastructure of the future stands in a category of its own. Over the next decade, the most valuable company in the AI world will be the one that makes intelligence cheaper, faster, and universally accessible. And that is why this remains my #1 AI stock conviction, not because of what it is today, but because of the future it is uniquely positioned to build. When stocks go down, most investors interpret it as a signal to retreat, a warning that something is breaking, that uncertainty is too high, that risk is no longer worth taking. But over decades of watching market cycles, disruptive innovation and technological revolutions collide with fear-driven sell-offs, one lesson rises above the rest. Downturns are not warnings to run, they are openings to reposition. They reveal which investors are driven by emotion and which are guided by conviction. And this distinction becomes even more powerful in periods when the world is undergoing technological transformation faster than the markets can properly price it. When prices fall, we are not witnessing the failure of innovation. We're witnessing the market's temporary inability to understand it. Traditional models, rooted in backward-looking data and linear expectations, tend to break down precisely when breakthrough technologies begin compounding. So when stocks tied to innovation decline sharply, it often says more about outdated financial frameworks than about the long-term potential of the underlying technologies. In moments like these, emotional investors see risk, disciplined investors see mispricing. What people often forget is that markets move in cycles, but disruptive innovation moves in curves, exponential curves. These curves do not slow down simply because sentiment weakens or because macro headlines dominate the front page. If anything, downturns tend to accelerate the adoption of technologies that make industries more efficient, more automated, and more intelligent. The world doesn't pause, innovation doesn't pause. But the public markets occasionally do, and that disconnect creates some of the most extraordinary opportunities of a generation. When stocks go down, especially those tied to transformative sectors, the question I always ask is, has the long-term thesis changed, or has the price simply overreacted to short-term noise? In most cases, the underlying fundamentals, technological progress, cost declines, breakthroughs in AI, robotics, energy storage, and genomic sequencing continue moving forward at a pace that is breathtaking when studied objectively. The market temporarily looks backward, innovation relentlessly pushes forward. There's also something deeply misunderstood about volatility. Investors often treat it as a permanent feature when in reality it's a byproduct of transitions. When the world shifts from one economic paradigm to another, from analog to digital, from physical to autonomous, from fossil to electric, from manual to intelligent, old valuations break before new ones are built. This breakage can look chaotic, even frightening, but beneath it lies a fundamental reallocation of capital toward the technologies shaping the next decade. Declines in innovative stocks are not a sign that innovation is failing. They're a sign that the market is struggling to catch up. Downturns also force clarity. Good companies become stronger. Weak companies reveal their vulnerabilities. Investors who rely on hype exit early, while those who study cost curves, adoption rates, and technological inflection points recognize that volatility is simply the price of admission for long-term outperformance. If you wait for stability before investing in innovation, you miss the exponential window, the inflection point where small, consistent actions compound into transformational outcomes. When stocks fall, the instinct is to think something has gone wrong. But more often than not, something has gone right because price is finally separate from short-term sentiment and allow long-term investors to accumulate assets at valuations that don't reflect their future relevance. Every major technological wave in history, the internet, smartphones, cloud computing, went through periods of profound mispricing. And each time, those who understood the long-term trajectory were rewarded not for timing the bottom, but for having the discipline to stay focused while others panicked. So when stocks go down, especially in fields where innovation is reshaping entire industries, the most important thing you can do is stay anchored in research, conviction, and long-term perspective. Because volatility may shake confidence, but it also unlocks opportunities that don't appear in calm markets. And those opportunities often become the defining moments that separate ordinary outcomes from extraordinary ones.